Unless you've been living under a rock, this could be the craziest week in the stock market this year. We have trillion-dollar companies reporting their earnings this week, including the likes of Google and Microsoft that just reported. We're going to talk about that. We've got the Fed set to raise rates on Wednesday afternoon, and everyone's waiting on Poppa Powell to tell us what's going to happen with rates and his opinion on inflation and the recession. And of course, on Thursday, we have the official GDP report where we could possibly be heading into a recession. We'll discuss all of that, what I'm doing with my trades and investments. So sit back, grab a snack, smash the like button, and let's get started. After a bit of resurgence recently, stocks have been falling for the past couple of days in anticipation of this big week. This is after we had some decent reports from banks, Tesla, and Netflix. But we have almost a third of the S&P 500 companies reporting their earnings this week. These results will definitely move the market big time. I can guarantee like 9 out of 10 people watching this video are invested in some of these stocks like Apple, Amazon, Meta, and Google, and Microsoft. These are companies that are in almost every big index fund that you own in your retirement account or your personal individual account. So this is absolutely important. If earnings are an absolute disaster and dumpster fire, we're heading lower for sure. So let's talk Alphabet. Misses on earnings and revenue for the second quarter. The company reported earnings per share of 121 versus 128 expected. That's not too bad. And revenue, 69.69 billion versus 69.9 billion expected. So pretty much in line. YouTube a bit below, with all the talk about advertising budgets not doing too well. We're seeing just a tiny bit of an impact here, not as much as what happened to Snap, of course. Cloud a little bit under as well. So all in all, these are, not the worst earnings. These are only misses by a couple of percentage points or half a percentage point. I'm pretty bullish on the stock. The valuations here are pretty compelling. You don't have a stock that's very expensive here at a PE ratio about 20 and a forward PE ratio of about 16, 17, relatively in line with what's the market at right now. That stock's moving up after hours, and now Microsoft misses estimates, but stock is up 5% after hours on rosy guidance, and that's pretty impressive. A lot of software stocks have dropped 60, 70, 80, 90%. Microsoft has held up very well. They reported earnings of $2.23 per share versus $2.29 per share. And that is, again, a very small miss, similar to Google. 51.87 billion versus 52.44 billion. It's rough out there when even companies like Microsoft and Google are missing their estimates. These are companies that consistently beat on revenue and earnings every single quarter. With respect to guidance, though, this is the important part because we're always a forward-looking stock market. The company reported 49.25 to 50 billion for the next quarter, and that's about 10% revenue growth, reflecting worsening PC sales and slower cloud infrastructure growth. But for the full fiscal year, they're reiterating their forecast from 3 months ago despite the economic climate, and that's what I think investors are really looking at there. So if the company is able to maintain its profitability and maintain its forecast despite the Fed probably going to increase interest rates a couple more times, despite a lot of people thinking that a recession is getting worse, the fact that the company is reiterating here and not bringing down estimates is a very positive thing. And that's similar to what Elon Musk at Tesla did when he said that the second half of this year could still be a record-breaking year. And here's a very neat chart showing Microsoft's products and services growth. And for the most part, its services are still growing in all of its different components. So overall, a double miss from Microsoft and Google, but not too bad. And if this is the trend that continues, we could continue to see the market climb itself higher out of this ditch. This is a chart of the S&P 500 change in forward 12-month EPS or earnings versus change in price over the past 10 years by FactSet. It could stand to reason that price again, after a bit of more consolidation and maybe some estimates start to go down a little bit, then price will recover in stocks. How the market reacts, of course, is entirely going to be determined by the Fed here and what Jerome Powell says and does in this upcoming meeting. The last time he spoke, markets went nuts. You saw moves -3 to 4%, and then back up 4%, and then the next day the whole market tanked 6%. Pretty insane stuff. I wouldn't be shocked if we see a lot of price movements here once again, and this impact, this change that's going to happen with the federal funds rate is going to impact everything from personal loans to mortgages and have a broad implication on the economy going forward. This is likely going to hit demand even more. We're seeing record lows for consumer sentiment. We're starting to see some commodities prices go down as well. We're seeing a lot of layoffs and hiring freezes. To our final point here, which is recession. Now again, on Thursday I mentioned that we're going to have that official GDP report, which is likely going to show a second consecutive negative GDP print. And the rule of thumb that a lot of people follow is 2 negative GDP prints in a row. That is technically in a recession. That is not something that everyone follows, and we don't have the same broad, death spiral sort of Armageddon situation that we had with the great financial crisis back in 2008.
Working the phone say a lot of their customers are freaked out, waiting to see how low the Dow will go.
Down 9% today. The Xetra DAX over in Frankfurt is down by 9%. The Paris market down by 9%.
Recessions come in different sizes and shapes, and I don't personally see another big crisis happening again, but there are some people that do see that. Regardless though, my plan is to invest long-term dollar cost average into high quality companies. You're investing to own companies, some of the biggest and baddest in the entire world, in a good way. And we're going to see those companies bounce back in a not too distant future in my point of view. As Warren Buffett says, you need to view yourself as an owner of a company, not just the owner of numbers on a screen or pieces of paper that we call stock.
And that's what stocks are, businesses. In fact, people will be better off if they say, I bought a business today, not a stock today.
For shorter term trading and especially options, I would really tread lightly and encourage everyone to do so because there's so much volatility already priced in. And with all those big price movements, it's easy to get wrecked, especially if you overextend yourself on the long side or the short side, and you pile all of your money trying to bet in one direction. Don't blow up your account over just 1 week in your market trading career. Now we have a Stock Dads Discord where we have books, live streams every day, trading courses, stock alerts, option alerts. Do check out the Stock Dads Discord where we have so much educational content for you guys. If you are gonna make some short-term plays here, consider doing a put spread for options, because that limits the amount of risk. It defines how much you're gonna lose, and it could hedge your portfolio if we do happen to see some really hawkish Fed behavior, if we have some bad GDP news, if we have some bad earnings. This week's gonna be absolutely insane, but just remember, again, it's 1 week in your trading career. Take a deep breath, and we're gonna get through this. For watching Stock Dads, check out this other video we made recently on investing in this bear market. I'll see you guys next time. Take care.